Hello and welcome back to Katie's Business Tips. Glad to be with you. Michael Lapede here, talking to you about what is the best structure for your business. And in this video, we're going to talk about corporations specifically. So a corporation is different from what we've been talking about, sole proprietors and partnerships, in that it's a separate legal entity. It's got a separate legal existence, almost like having an artificial child. It's created with its own birth certificate called a certificate of incorporation. It is a separate entity that is completely separate from you. Okay, and because it has that, legal existence separate, it needs to make sure that it is structured in a way that's conducive for your planning because it's separate for you, but it has to tie in with your planning. So we have three parties. We have the shareholders, which are the owners, just like if you own stocks in a public company, you own shares in a private corporation, same kind of idea. You're the owner, you take no liability. Second party would be the directors, and the directors do take the liability, call the shots of the company and so forth. And then we have the officers that are titles, can do day-to-day, can do banking, things like that. So you might have CEO, CFO, president, vice president, secretary, treasurer, grand poobah, whatever the name is, right? You have titles as an officer. So these are the three parties, and these should tie in also with your planning. And again, consult a professional. Now, there are many advantages, of course, of incorporating, and there are some disadvantages. So let's talk about the advantages because there are quite a few. First of all, provide some limited liability for you because it's a separate entity for the shareholders. So it's separate from the shareholders and therefore a legal liability, the liability of the owner, the shareholder, legally is now minimized. Okay. A corporation provides flexibility in the organization of the business. So you could have different shareholders, multiple shareholders, people that are coming in as shareholders as family members to split income. You might have people that are coming in with money and you make them a shareholder. You could have different boards of directors or different people on the director taking the liability and different officers, right? There's flexibility in that structure. A corporation also has a perpetual existence. So when a shareholder passes away, the corporation doesn't die. Now, someone's got to take over those shares and so forth, but the corporation and the business stays going past when one of the shareholders pass away. Now, the other thing that's nice is control of the ownership of a corporation. You can easily transfer control by moving the share percentages around so that someone would own over 50% or greater than 50%. Therefore, the majority owner can control the company. So that's easy to maneuver, that control of the company, because you simply do it by transferring or selling shares. Now, you can also use those shares to raise capital, as I mentioned, right? So it's easier to raise capital when you can distribute shares to a partner and say, hey, they want to partner with you, they want to put money in, you can issue shares for that capital raising. And on a bigger scale, even in the public, if you want to go through securities and do an offering, and there's all kinds of things you can do for bigger money too. Corporations also offer significant tax advantages compared to other forms of structures when you're tax planning in advance. And that's the key. We talked about that in many other videos. So lots of advantages. Let's look at a couple disadvantages or a few disadvantages. The first one is the cost of creating and maintaining the corporation can be high. You have $1,500 to set it up or so currently. And then you're maintaining it each year. You got to do the corporate year end, which is a few $1,000s. You got to do the annual return with the registry. So it can be a little costly to have all those benefits. Now, also, of course, the laws governing the corporations are much more complex, and that's why you need a professional. Sole proprietor, you might be able to do it on your own. Corporation, you're not doing it on your own for sure, right? And the last one is the shareholders cannot use the corporation's losses. When the corporation loses money, they can't just write that off on their personal tax like the sole proprietors can, for example. The corporation has to use that loss in the future or carry it back. Carry it back 3 years or forward it into the future when it can use it. But you cannot move that loss to the individual. The only time an individual receives a loss is if they invested money in the company, it goes bankrupt, and then they get to claim that loss of money they invested. Now, that's different, though. If the company has losses, there's no claim. So that's about it. If you've got any questions, we'd love to hear from you. Thanks for being a part of our Katie's Business Tips, and we'll see you in the next video.